In this video, I want to chat to you guys about the basic break-even analysis. Remember, we're still busy with our free business mentoring program, and we're still busy looking at the first phase, which is the planning phase. Before we even start the business, we're just going through the planning phase. And in today's video, we're busy with the eighth section inside this first phase. Remember, the first time we looked at the business ideas, how to create business ideas. Second one was how to test business ideas. Looking at target market was the third one. Fourth one was competitor analysis. Then we were looking at vision. SWOT analysis was the sixth one. Seventh one, I introduced you guys to the basics about financial planning. In today's video, or this video, we're going to be talking about the break-even analysis, and I'm going to throw in some cash flow statements as well for you guys that you can go look at. And so these documents that we're busy discussing, in the description of this video, there will be a link to a web page where you guys can go download all these different work pages that you can download it, put it onto your computer, then you can crunch your own numbers on this as well. Before I jump to my computer, just remember to give the video a like, remember to hit subscribe, and let me jump to my computer, then I can show you guys the basics about break-even analysis and cash flow projections. Right, so the first thing that I want to discuss with you guys is break-even, and I did a course the other day where I was talking to a group of business people, and a lot of people don't actually understand how they make money. And I think this is where break-even analysis is really, really important, just to understand the basics of how your business works, where you're busy making money, or how do you make money. So just the basics, if you look at your basic formulas, a gross profit means that this is selling price minus your cost over your selling price. So then if you take an example, let's say for instance, if your selling price, you sell something for 15 Rand, your cost for that product is 10 Rand, which means that you've got a gross profit of 5 Rand. So if you look at the percentage, remember we said the selling price minus the cost. So if you take the 15 Rand minus the 10 Rand gives us 5 Rand over the selling price. So 5 Rand over 15 gives us 33%. So now, this is where it becomes really, really important or really interesting, is when you start looking at how much you need to earn to break even, because that's just basic calculation. Sell something for 15 Rand, your cost price is 5 Rand, or no, 10 Rand, it means that you've got a gross profit of 5 Rand. But if you have a certain amount of fixed cost, how much would you need to sell to make sure that you cover those fixed costs? In my example, I said that in my business, we've got operating expenses of 40,000 Rand. Then it means that if I pop that into the calculation or the break even, the equation that you use is to say, what is your operating expenses over divided by your gross profit percentage. So if I take 40,000 Rand and I divide it by 33%, which means that I need to sell 120,000 Rand worth of products in a month to be able to cover my cost of 40,000 Rand. So here at the bottom there's just a test that I put in over here to say that if my selling price is 120 Rand, remember that my cost price of those products would be 80,000 Rand, so it means my gross profit is 40,000 Rand, operating expenses was 40,000 Rand, and therefore your profit is 0. So I think you can fiddle around a little bit with those ones as well, or just with those basic calculations to say that if my operating expenses is 40,000 Rand, but I'm planning to make a 10,000 Rand profit, so then that amount becomes 50,000 Rand. So what would that equation then looks like? So then you can crunch those numbers on the spreadsheet. Like I said, I'm giving it to you, I'm putting it back down on my website. You can go download it, fiddle with these things. And it's really, really important for the planning phase of your business to understand how you're actually going to make money. And even for existing business, a lot of people don't know this. They don't know how to actually make money and how much they're supposed to be selling stuff for. Because if your operating expenses is high, your gross profit is low, then it means that you just need to start pushing more and more and more sales to be able to break even on a monthly basis. So here on the right hand side, there's one or two things are also really, really important. Daily operating costs. So then if you look at your operating cost, if it's 40,000 Rand, let's say for instance you trade for 20 days in a month, then it means that your daily operating cost then works out to 2,000 Rand. So then if you look at your daily break even on the same calculation that we had over there, it means that your daily break even, you would have to sell 6,000 Rand a day just to cover your basic operating expenses. On a weekly basis, we take that amount, multiply it with the amount of working days, it's 30,000 Rand. So this is, like I said, just very roughly, and obviously you as the business owner will know that certain types of industries, let's say for instance like restaurants, during the week you're not that busy, and that's where it's nice to look at a weekly one. and weekends things pick up a bit, then you can go and say, okay, what is my weekly target that I need to sell? So then if you know 30,000 Rand, then 30,000 Rand is my target. What do we need to make per day? Then again, obviously push the business itself to make sure that you hit those targets. So then, so then just the question is, a services related type of businesses, how does that work? So remember that if you buy and sell something, you always have a gross profit percentage. But now with services, if you're selling price, the expenses is 250 Rand for something, your cost of that thing is 50 Rand, then it means your gross profit is 200 Rand. And if you look at the percentages, it means that you have an 80% gross profit. So in our same example, if I take 40,000 Rand divided by 80%, gives me a break even of 50%. But now remember, if you render services, there's no cost. So which means that if you selling price is 250 Rand, cost price is 0, so your gross profit is 250 Rand, which means your gross profit percentage would then be 100%. And you can see then the break even is 40,000 Rand. So then on a daily basis you need to get in 2,000 Rand. I remember when I started my first business, you could wake me up 2 o'clock in the morning and ask me what my daily target was. Now I could tell you exactly how much I needed to sell on a daily basis to break even. So it's really, really important for you as a business owner, especially the first year and two, is you must keep your finger on the pulse with these things. If you don't, then cost and stuff can escalate quickly out of hand. So it's really, really important just to understand the basics of this. Yes, so the second tab over here, I just made a separate tab over here for daily running cost. I did the same calculation on the previous page as well. So if you have a 40,000 Rand operating cost, 20 days in a month that you're operating, then you can see your daily cost would then be 2,000 Rand. Daily break even would be 33%. If it's on 33%, then you can see you've got 6,000 Rand daily target. Then your weekly target would be 30,000 Rand if you're operating for 5 days. I put in this little tab over here as a bonus. So if your sales is 8 million Rand, so this is just an example of one of my clients. Long time ago, a couple of years ago, was 2015, and just 2 examples of how these people invested in marketing and the return that they had on that. So in 2015, this specific client of mine spent 230,000 Rand in marketing, and their business was doing a turnover of about 8 million Rand for that year. The next year, she pushed the marketing cost up to 330,000 Rand. Check out her turnover jump, 14 million Rand. Next year, she pushed that marketing cost up to almost 500,000 Rand. So that's about 40,000 Rand a month. Turnover jumped up to 20 million Rand. So that is just marketing, guys. You must put it in. I'm going to do a whole separate video on marketing, and we're just going to unpack that a bit more. I'm not a specialist in marketing, but I do see the guys that invest in marketing, that they do reap the benefits of that. Yeah, another example, also one of my clients, 2021, they spent 14,000 Rand in marketing, turnover was 2.6 million. The following year, they pushed that marketing expense up to 50,000 Rand. You can see the turnover more than doubled, 6 million Rand. The year after that, they pushed that, tripled that, the amount of money that they spend on marketing, 180,000 Rand. And you can see that their turnover jumped to 12 million Rand. So marketing, like I said, I'm going to do a whole separate video on marketing, but it's really, really important to say that if your turnover is 50,000 Rand a month, what is that percentage that you're going to be spending on marketing? If you look at your big companies, they spend lots and lots of money on marketing. We will unpack that a bit later. Cash flow, yeah, here we go. So this is also really, really important just to understand the basics of cash flow. Like I said, this is this old sample that I had that I just took out of my archives, and I'm going to leave this, guys, for you. And this was, I think, a coffee shop or something that we worked on. And you'll see that at the bottom of the spreadsheet, we did some basic calculation to say that if your sales is 80,000 Rand, they estimate their food cost to be 27,000 Rand. Normally, most restaurants, you can probably work with a food cost of about 30 to 35% that they work as the food cost. So we worked with 34%, so which means that their GP was 66%. So then their break even would be about 89,000, about 90,000 per month that they would have to sell, because you'll see that their fixed cost was about 60,000 Rand. So if you could do the calculation, then we'll see that that is what they need to sell every month. So if I do this calculation over here, I just want to show you guys quickly. So you always start with the opening cash flow balance. So this amount over here, you must type in yourself to say this is what the opening cash flow balance is, how much money you have in the bank now. Obviously, you can update the dates at the top over there. This is quite an old cash flow. And then you can think now, for this business, what would you estimate your sales to be? And you'll see that I just worked with a formula over here to say if it's 80%, I said 34%, which is my food cost. So that would give me those amounts over there. And then obviously this one, you can see I just took the total sales. There's the food cost, give me my gross profit. And you can see at the bottom over here, we've got my operating profit of 59,000 Rand. So therefore, for this month, you have a negative cash flow of 6,500 Rand. So which means that if I start with 10,000 Rand in the bank, it cost me 6,500 Rand, then you can see that I've got a closing bank balance of 3,500 Rand. That balance then carries over to the next month. Then in the next month, you see we budget or we estimate the sales to be 120,000 Rand. So therefore the food cost will be 40,800. Your GP is about 80,000 Rand. So now I can see your gross profit 59. So that month you have a positive cash flow then of about 20,000 Rand. So just the bottom part, just to explain to you, you can see here I've got something for variable cost. You can probably change that description to whatever you want to make it. But you can see we've got accounting fees, we've got advertising, bank charges, point of sale, we've got depreciation in there, entry fees. So all the type of stuff that you can think of, you can pop into this thing over here, and then it obviously adds it up as the total variable cost. Like I said, the heading might not be 100% accurate, but it's just what we did back then. You can see over here we've got the fixed cost, we've got a salary for the director, for barista, for a chef, and we've got rent in there, insurance, salaries for cleaners, zero other salaries. So you can see that the fixed cost was 51,000 Rand, so the total cost then works out to 59,300. And obviously this thing isn't fixed. You know, when you start up a business, that first month or two, you're going to add some columns over there to say that buying equipment 200,000 Rand, setting up the shop 100,000 Rand. But then you must make sure that you put in those amounts there into your cash flow to say that you have an opening bank balance of 500,000 Rand. I'm just taking that as an example. So that you can then calculate to see, listen, am I going to break even? Am I not going to break even? So this is just a sample one. You'll see on the next tab over there, it's then the exact same sample, but it hasn't got any amounts in. So except for the opening cash balance of 10,000 Rand. So you can go and adjust it yourself. So put in what you have in your bank, put in what you expect the sales to be, what your cost of price is going to be, and what your gross profit is going to be. With VAT, it does change a little bit. So here's the example of businesses where we work with VAT as well, you see. So there's our total cash receipts. So remember, these amounts are including that we're busy working with over here. There's our direct cost to produce the income, then 80,500 Rand. Then you can see here's a separate calculation. So you can see that it takes, at the moment, this thing is still set to 15%. We know that the VAT increase is coming through very, very soon. So that amount is obviously set to change. But you can see the VAT on your sales, then there's 15% there. And then you can see your VAT on your direct cost. You can see that amount over there, and then the input VAT on your operating expenses would then be 3,600 Rand. So that would be then the VAT payable. So it's just another line that just gets added to the calculation over here, you see. So you can see there's your total payments, would then be your operating cost plus the VAT, and that gives you your total payments. So the operating cost, we just broke it up into two different sections. So all the stuff that is VATable, you would put it into the top section. All the stuff that does not have VAT on, you put in the bottom section. Remember, you can't claim VAT on every single expense. It's only people that you buy from that's actually registered for VAT where you can claim the VAT on. So here's a whole sample of one where we accounted for with VAT, and then here's just the same cash flow, but just a blank one that you guys can take to complete. But I think what's important here is this first tab, to make sure that you understand your business model. How are you going to make money? What will you be selling product for? What is your cost price? What is your GP? What is the expected monthly cost? And then to do that calculation over there to see whether it's worth it or not. And then, in the next video, we are going to be looking at the basic operations of a business. That's going to be a little bit more on the not technical side, but just operational things, things just to consider in the day-to-day operations of your business. I hope you guys are enjoying the series so far. Remember, once again, just to give it a like, hit subscribe, and I'll see you guys for the next video.